Get the bits of nuts out of my teeth first. Looks okay. If you're working, chances are that income tax and national insurance are a pretty big part of your life. But do you really understand how they work? Welcome back to 5 Minute Friday. I need a new studio. Too much road noise. I was a little bit camp. Yes, 5 Minute Friday is back after a short hiatus where I was, frankly, starved of inspiration. And then I had a thought. Why don't I ask the Facebook group what you would like to hear about? And that just really reinforces what an idiot I am, because I could have asked that weeks ago, because I had something like 30 responses within 30 minutes and there's now way more than 70 responses on that post. So lots of material to be going on with. So let's have a look at how income tax and national insurance work and put 5 minutes on the clock down here. Say a quick thank you to my friends at 7 Investment Management for continuing to sponsor the show down here. And let's crack on. Firstly, this is going to take a couple of episodes at least. There is no way I can get this in anywhere near 5 minutes. So we're going to break it up. Hope that's okay with you. Now, the first thing we need to understand is that income tax is worked out in bands. So that's why I've sort of scooched across to the side of the frame here so that I can bring in this lovely graphic. So we need to think in terms of bands with income tax. And the first band is called your personal allowance. As I record this in late 2019, the personal allowance is £12,500. And the personal allowance simply means that you pay no income tax at all on any income below that amount. The personal allowance changes each year, and it's changed a lot in recent years, become a bit of a political football, dare I say. Now, the next band on top of the personal allowance is the basic rate tax band, and that takes you all the way up to £50,000 in total. So the income you receive between £12,500 and £50,000 is taxed at 20%. After that, we've got the higher rate tax band, which takes you all the way up to £150,000. So anything you earn between 50 grand and 150 grand is taxed at 40%. And then we've got the additional rate band, which is anything over 150,000, and that is taxed at 45%. Now that's easy, but that actually only applies in England. There are different rates in Scotland and Wales. I'm not going to muddy the waters here with those. Suffice to say, there are 6 bands, not 4 in Scotland, so it's more complicated if you're north of the border. So if we just stick with the English bands for now, hope that my Celtic friends will forgive me for that. So income then is stacked against those bands to determine how much tax you pay. Important to say though that if your income takes you into the next band up, let's say you're earning £51,000, whatever, right? And that's 1,000 into the higher rate tax band. It's really important that you know that not all your income is now taxed at 40%. It's only the income which falls into each band which is taxed at the right rate for that band. So in that example, you'd pay 40% only on the £1,000 which is above and into the higher rate tax band. So we need to talk about types of income. This is important. Essentially, there are 3 main forms of income. Firstly, we've got earned income. So that's earnings from your job, from your work if you're self-employed, but also crucially it includes rent. So if you've got rental properties, rent is deemed to be earned income and is taxed accordingly. Also, it includes pensions, which is important to remember too. Then we've got savings interest. So that's interest paid on money held in the bank, but also includes peer-to-peer lending, income that you might get from funds that you've invested in, which are primarily bonds, and of course it includes interest paid by any directly held corporate bonds or gilts. And thirdly, we've got dividends. So if you are a shareholder in a company, or if you invest in a fund which holds shares primarily, then the income you might receive from those investments will be in the form of dividends. Now that's actually the order in which your income is taxed. And so when your income is all added up and it's stacked against our bands, it's done so in that order. So you get your earnings and your rent and your pension, if that applies to you. Then you get your savings, and then you get your dividends. And they're stacked in that order to work out what percentage income tax you're paying on each bit of your income. Now that's important because there are actually some different tax rates at play for the different kinds of income. And this is notwithstanding the differences in England, Scotland and Wales, okay? This is just the different kinds of income that you might receive. So earnings and savings are taxed at the rates I mentioned earlier, which is 0% for earnings and savings in the personal allowance, and then 20, 40 and 45%. Dividends, though, are different. Any dividends you receive within your personal allowance, they're tax-free. After that, in the basic rate band, the income tax rate is 7.5%. Then the higher rate is 32.5%, and the additional rate of income tax on dividends is 38.1%. Somebody was paid to work out what those percentages should be. Now, why not just round it down? Okay, so we've got our bands and we've got our different kinds of income which are stacked on top of each other against those bands so we can work out what income tax rates we're going to be paying on what bit of our income. Lastly for today, we need to talk about allowances, and there are a few of these. So firstly, we've got the personal allowance, which we've already mentioned. That's the first £12,500 of your income from any source, which is tax-free. That's £12,500 in the 1920 tax year. It changes every year. So that's straightforward enough, except it isn't, because if you're a high earner, if you're earning more than £100,000 per year, then every £2 you earn in excess of £100,000 reduces your personal allowance by £1. So that means that if you earn over £125,000, you don't get a personal allowance at all. And that, frankly, sucks, because for every pound you earn between £100,000 and £125,000, you're paying a notional 60% income tax rate. That's the 40% income tax you're paying already, and the extra tax you're paying because you're losing the personal allowance. Now, if you're registered blind, there is an additional personal allowance. Again, that changes every year. In 1920, it's £2,450. So you get that on top of your personal allowance, which simply makes your personal allowance bigger. Okay, got that? That's the personal allowance. Now we need to talk about savings, and there's two kind of bits of allowance here, which is just confusing. Firstly, we've got something called the starting rate for savings. And this says simply that up to £5,000 worth of interest in any tax year that you receive is tax-free. But if you have non-savings income, say earnings or dividends, above the personal allowance of 12.5 grand, then that starting rate for savings band is reduced on a one-for-one basis. So let's say your salary is £15,000. That's £2,500 over the personal allowance. Your starting rate for savings band is therefore reduced by £2,500, which means you can only get 2.5 grand of interest tax-free. So if you have other non-savings income over £17,500, you don't get any starting rate for savings band at all. And then there's the personal savings allowance, which applies to everybody. And that says the first £1,000 of interest that you get in any one tax year is tax-free if you're a basic rate taxpayer. If you're a higher rate taxpayer, it's only the first £500 of interest that you can get tax-free. But that is on top of the starting rate band. Go figure. See, nothing's as straightforward as it seems at first glance, is it? That's why people like me have a job. Finally, though, the dividend allowance, and this is straightforward. This simply says that the first £2,000 of dividends that you receive in any one tax year is tax-free. After that, it's stacked up on top of your income and you pay the relevant tax rate. I don't know about you, but I think that's quite enough for today. We're probably way over 5 minutes anyway. I can't tell, you see, because I can't tell until I do the edit. But my gut says it's a little bit more than 5 minutes. Never mind, you've been deprived of 5 Minute Friday for the last few weeks, so I'm sure you can forgive me the extra minute or two. Next week we're going to go on and talk about a little bit about how to make the most of the various allowances, particularly using things like pension contributions. And then we'll talk a little bit about national insurance as well, which, despite the fact that it's called insurance, is nothing of the sort. It's just an income tax. Thank you so much for watching. Have a great weekend, and I'll see you in next week's 5 Minute Friday.